Hello and welcome to an all-new edition of What Are Your Thoughts? I'm your co-host, Downtown Josh Brown. I'm here with my co-host, Michael Batnick. Michael has no idea what I want to talk about today, and I don't know what he's going to ask me about. It's our favorite game. Play along with us in the comments below. Let's get into it. Okay, Mike, I'm going to go first because that's just the kind of guy I am. Take a guess. Which is outperforming which on a 3-year time frame? GLD or SPY?
SPY.
By how much do you think?
All right, so right now it's July 2020, so we're going back 3 years.
So 17.
I don't know, 15%, 15-20%.
Yeah, I was really surprised by this. Actually, GLD is outperforming SPY on a 3-year, not that it's important in the real world, but in the investment world, It's kind of like a very notable. I think it's 56 versus 4. I think it's 48 versus 36.
So we got 46 for gold, 36 for stocks.
Okay, so those are the two ETFs, like without getting into futures and all that stuff. So I was surprised by this. Gold miners haven't done nearly as well.
You know what? Over 5 years, it's even way closer than I would have thought.
It's almost neck and neck now,
so
right?
Over 5 years, stocks are up 65. This is total return for the S&P. Gold's up 52. Wow.
Gold's up 52 over 5 years?
Yeah.
So like as an annualized return, that's like pretty good.
And you know, it's interesting since inception. So GLD goes back to, what was this, 03, I think? No, I'm sorry, 04. 280 for gold, 260 for stocks.
Since inception. Right. Now do NASDAQ.
Yeah. I thought inception was earlier. Anyhow, what are you getting at?
I was surprised by that. I think so gold is now at the highest level it's been since the summer of 2011 or the spring of 2011. Yeah. So I do think it's a new bull market for gold. I don't think that it's another head fake, like obviously. But bigger picture.
Wait, what's obvious? You're saying it's obviously not a head fake? How is that obvious?
No, well, if it's at a new high, it can't. I'm not saying it has to break through, but it's $50 away. It's like it literally rallied to here from 1100.
Right.
Like it's not like all of those rallies from 1100 to 1300.
So it went from a high of 1911 in 2011 to a low of 1046 in 2015, back up to 1800.
Okay, so two notable things about that. When it was at that high in 2011, it had a lot more assets under management.
It was the biggest ETF in the world.
Yeah, it was bigger than SPY for a moment, and that was actually a great sell signal.
That was the top.
Yeah, so I don't think that people talk nearly as much about gold now, heading back toward these highs, as they did in 2010 and 2011, when it was like literally there was a gold ticker sitting on CNBC above the Dow. It was every day the discussion was gold. Part of me feels like this rally's been so stealth because a lot of the people who would traditionally be talking about it are off in crypto land. And
or talking about the virus, which has dominated everything. By the way, peak assets in 2011 were 70 billion. Right now it's poking there. It's 69.6. So it's right there.
It's getting close. Okay. So I feel like it's just not as big of a topic of conversation because of the virus. And then also you have technology stocks that are up like 400% in 6 months. And those are really the things that people are most excited about. When gold was peaking in 2011, it was the only thing working. There wasn't anything else. So I think
about what was going on in the context of when gold was ripping. It was double dip recession. It was euro blow up. It was the U.S. Credit getting downgraded.
That's right. The debt ceiling fight. So I think this one is interesting. This one looks more like a bet on inflation than it looks like what was going on in 2011 when they were talking about the destruction of the dollar. And, there's a lot of like Obama fear. So I think this time it's more like, look, the Fed is printing like $12 trillion. It's very obvious the cost of things will go up. And by the way,
but gold's been rallying before the Fed started, before COVID stuff.
It started in the fall. I also think that lumber is up. Copper is up.
What's going on with these? I don't understand. So I get the lumber thing. People are redoing homes. Home Depot and Lowe's are at all-time highs. Like projects all over the place. Why is copper, which is in theory the most economically sensitive commodity. Why is that going so far up?
China.
So
China's engineering a stock bull market. Like, you can dislike the fact that they are trying to do that, or they're able
they
to
did
do
that.
that.
They did that in 2015 and it popped.
Oh yeah, they're gonna do it. They're gonna do it this time. They're doing it again. Margin balances are ticking up in Chinese brokerage accounts again. China is the most similar to the United States in terms of the leadership of the market. They have like 20 gigantic technology companies. China, actually, we're getting very far away from gold versus SPY. But the copper story feeds into the economic recovery in Asia, I think.
Okay.
Like if you ask me like what's behind it, that'd be my guess. All right, that's all I got on that.
Okay, so you sent me a post from GMO talking about emerging market stocks, and they brought up a couple of points that I want to talk about. They said they gave 5 reasons why emerging markets are more resilient today than in prior periods, and the long and the short of it was index construction. And it's kind of funny because one of the knocks on EM is that it's like 40% China. They're actually saying that's a positive. And 2 of the reasons are they say the weight of vulnerable countries in the index is significantly reduced. And what they mean by that is economies that are highly dependent on foreign savings and therefore more exposed to external outflows. So that's gone way down. And then number 2, and I thought this was really interesting, the move from cyclical stocks to tech and consumer. So
that's right.
Previously, you thought that EM was like sort of a levered bet on commodities, and that used to be the case. Energy and materials in 2010 or 2011 was 30% of the index. Now it's down to 13. Tech, which was 15, is now a third, and 26% of the index is China consumer sectors. So the entire makeup is totally different.
This is the difficulty in comparing asset classes like stock sectors or stock indexes or even country markets across different time frames. Because people get used to this shorthand where they say, oh, iron ore and oil prices are going up, then I want to be long EM. So like when you used to think of EM, you would think of Pemex, like the big Mexican oil company, and the Brazilian oil companies, which dominated the index, and PetroChina. Like that's what you would think in your head. And you would say, oh, cool, there's a rally in commodities. Let me get long EM. The story has changed so substantially, and the index construction along with it, that I think a lot of previous data on the EM asset class, like you could throw it out the window. It's not all banks and oil companies anymore. And I was about to make this point in the earlier question, but like China actually did something very wise and forward thinking. They blocked US technology companies and nurtured their own homegrown, and now their homegrown companies are bigger than technology companies in Europe or anywhere else. Like they didn't let Facebook come in, which is why Weibo was able to take off, and WeChat and all of these homegrown services that are now 1 billion people. They let Baidu become the Google of China rather than Google become the Google of China. And, you know, we can go down the list, Alibaba and JD.com instead of Amazon and eBay. So I think they did this very intelligently, and now they're at the point where they don't even care about access to U.S. markets. This came out the other day. Ant Financial, which was formerly a part of Alibaba, it's basically an enormous fintech company that handles everything from money market funds to payments. Ant Financial is going to do a $200 billion IPO. Out of the gates, $200 billion. And they're going to do it on the Hong Kong exchange. In other words, they're not even talking to New York or London. This is unheard of. Even 5 years ago, you could never have done an IPO of that size without involving Goldman Sachs and JP Morgan and this one and that one. So if you think about the fees involved, I mean, you could be talking about $50 to $100 million in fees not going to Wall Street because they're going to do it there. So that's what EM looks like today. And it's a totally different ballgame than even 5 or 10 years ago. I agree with you.
What do you got?
I want to talk about the futility of sector bets. I think me, you, and Ben were talking about how stupid this was. We were looking at like the bank sector.
I disagree with you, by the way, but continue.
All right, so let's get into that. I think we were looking at the S&P 500 financial industry, like the sector. And I think it's made no progress since 2006. What was the relative to the S&P?
We were looking at tech stocks relative to banks and relative to energy.
Oh, right. A ratio of tech versus financials. But I was making the point, so many of the fastest growing financial companies are not even in the XLF. They're in the tech sector. Visa and MasterCard and PayPal.
Consumer discretionary, I think. Oh, wait. Is it tech?
Whatever.
No, it might be tech. You're right. I'm sorry.
No, Visa and MasterCard are in tech stocks, according to the S&P classifications.
XLK.
Right? How stupid is that? So, what do you mean tech versus financial?
So Visa,
it's very arbitrary.
Visa and MasterCard are the third and fourth biggest holding in tech. Of course, they did a reconstitution, so Facebook and Google are now in communications. But PayPal is a top 10. So PayPal, Visa, and MasterCard, like those should be financials.
That's my point. So when people are like, "Oh, do you like the financials here?" Well, which ones?
Okay.
And how are you getting? You think XLF is giving you exposure to the real financial economy? Venmo's not even in there. That's how people spend money now.
Well, for some reason, I think American Express is in XLF, but you get Berkshire, you get all the big giant banks, so you are getting financials. I mean, I think
you're getting insurance. You're getting insurance, and you're getting traditional marble lobby and stone column banks. Is that the economy? Yeah, you're getting the broker dealers. Is that the financial economy, IRL?
So
no.
I think that you're absolutely right. You're definitely not getting the future of these industries. But if you're doing sector analysis, like I don't think that's broken. I think you're right and wrong.
Okay, hold on. Walmart and Target are in two different sectors.
Really?
Yeah,
Walmart's
Target's
a staple.
Consumer discretionary.
Walmart's a staple?
Walmart's a staple. What the fuck is that?
Okay, fine. But if you're just looking at the sectors, they still do tell the story of what's going on, even though you're right.
Okay. Amazon's not a tech stock, yet the fastest growing part of its business is cloud services. But Amazon is considered consumer discretionary because I bought a book there in 1997. I don't like this idea of playing sectors. I understand, like, sometimes when you just want exposure to 50 stocks in an index, it is the smartest way to do it. But, like, you're really missing the forest for the trees when you're looking at XLF versus XLK and saying, wow, tech is so much more important to the economy than finance. It's not reality. It's a committee.
It's not a complete picture, but I think it does a good enough job.
Wanted to get that off my chest, Michael.
Okay. I hear you. All right. So this is tough. Elon Musk now has a bigger net worth than Warren Buffett. That's a tough pill to swallow.
I knew you were gonna say that. I almost picked it myself, but I had a feeling this was going to come up.
I mean, what do you even
say?
First
of all, it already reversed overnight.
Okay.
It already reversed overnight.
Forget about it. But just in general, like what?
Here's the top 10 as of right this second via Bloomberg's Billionaires Index, which is hilarious. Bezos number 1, Gates 2. Gates is like the only guy that's been in the top 3 for most of the last 20 years. Bernard Arnault, which is LVMH. So Champagne and Louis Vuitton. Zuckerberg 4, Ballmer 5, Mukesh Ambani, which is I think the only one from India. I think he's like steel or something. But they're close. Larry Page is 7, very close to Ballmer. Those two could probably oscillate every day, go back and forth. Buffett is now 8.
Do you think
Sergey is 9, Elon is 10?
Do we think that Tesla is the first mega cap stock in a long, long time that we can say with a very high degree of confidence, like 98% chance that this thing right now is a bubble?
Of course it's a bubble, but that doesn't mean it won't keep going up.
I'm not saying that. Hold on. I'm not saying that you could time it or whatever. I'm just saying, when's the last time that we said, okay, this gigantic mega cap company is so obviously a bubble and so clearly doesn't make any sense at all?
Maybe this is the first time in like 15 or 20 years. I don't know.
What would have to happen? What would have to happen for this to make a little bit of economic sense? Like, what would Tesla have to do in the future for this to make sense?
I thought Ford or GM goes away. Like somebody gigantic in the auto industry has to like sell itself and just consolidate. Like, because they're all going to still fight for market share for the foreseeable future. And if coronavirus didn't wipe any of their competitors out, it's going to be ugly. And I understand that Like, I think Tesla has done an extraordinary job at the number one thing that matters right now in the modern economy, which is building a brand. That's like I almost feel like if you can build a brand, you could fix every other problem that you have. So he's done it, and they're not going away. And the questions about their financials, like, I'm not saying that I am an expert in Tesla's accounting. I just don't think it matters.
Forget about that. I'm not even talking about the financials. I'm just talking about the stock price and the market cap addition has gotten so nonsensical. What would you, if you had to put a number on what is the probability that this stock falls 50% or more over the next 12 months? Would you say there's a 40% chance, a 70% chance?
Oh, I would say there's like a 20% chance, just because I understand the enthusiasm for people that will just run right in and buy it on every dip. And the people that have missed out on the whole run, how motivated they'll be to come in and buy it back.
So you think that it could take a while for the enthusiasm to wane?
Look, I'm around a long time. There have been similar situations, but not as extreme.
And not this size. Not this size.
Right. Well, that's what I mean by extreme. Where companies just looked completely invincible at a certain point, but it never lasts. By the way, you know who one of the 10 richest people of all time in world history was? Henry Ford. At the peak of his wealth, he was worth $199 billion, according to one study, in today's dollars.
Wow.
In today's dollars. So I'm just saying, that was an automaker in a prior age. And he's on a list, by the way, just to give you some perspective. Like, the other people on the list are like Genghis Khan and, obviously like Rockefeller and that whole crowd. And then like Joseph Stalin. Like, so.
And Elon Musk.
Well, Elon Musk is not even close to that list. But here's something Larry McDonald is saying. He's calling this the greatest front run ever. He thinks it's 100% based on people front running S&P inclusion. If they report earnings on July 22nd and they're profitable for a third consecutive quarter, et cetera, he's saying that S&P, the committee, which we were just mocking for their sector weights, will have no choice but to include the company at a $300 billion market cap. It's bigger than almost every other stock in the S&P. So his post was called Inclusion Games. And he's basically said, let me read you this one thing. This is a study done by the New York Fed looking at stocks that have been included and in the S&P 500. And they're saying the pre-inclusion changes in firm characteristics are substantial. For our sample, on average, the increase in market cap in the 2 years preceding inclusion, adjusted for changes in the aggregate market level, is 56%. So the stocks that get included are always momentum stocks, and they always way outperform the market, which I think we know Tesla has done. But then they point out the total increase of earnings per share in the fiscal year before inclusion is about 57%. So the way Larry's framing it is, there's a heavy incentive for companies to juice earnings ahead of inclusion. So to Larry's point, is Tesla doing things now, putting expenses off till later, in order to get over the goal line and get the stock into that index because of all the forced buying it'll bring in? Other people have done it. It wouldn't be totally shocking. And I don't think the committee can ignore it. So I know they have the right to kind of like use their own judgment, but they can't just be like, no. Do you agree with that?
I don't know what the exact rules are. I know that they can use discretion when adding. If a company meets the criteria, I don't know that they can reject it. I'm not sure.
To be included in the index, company must meet 8 primary criteria having to do with market cap, liquidity, financial viability. So if it
meets all of that, can they still say no?
They say that they can. I say then you have a fake index that doesn't reflect the U.S. stock market. If the company meets those criteria and S&P's like, no, then what is the S&P 500?
There's a lot of companies, giant companies that aren't in yet because of the earnings stuff.
They wouldn't be in the top 10.
Zoom is...
that's what makes this so glaring.
Zoom. What is Zoom now? 70 billion? I have no idea. It's a lot.
Yeah, but they want companies that have sustained profitability, which I agree with.
All right, what do you got?
But we're getting there. When was the last time you got triggered, like emotionally, either positively or negatively, by somebody else's stock market opinion or economic opinion?
It happened. I remember exactly when it happened because I was in bed getting angry, wondering why I was doing this to myself. Who was it? I'm not going to name names, but I don't remember.
No. You don't have to name the name. somebody said something about a stock that you disagreed
no,
with?
you know what?
I
forget. I forget what it was. I think it was. I don't even remember. It was probably a year ago. It happens to me very, very infrequently.
I came to a realization the other day. I was thinking about this. There's literally nothing that anyone on earth could say about their take on the pandemic economy, the Fed, the level of the stock market, the valuation of an individual stock. I really don't think there's a single thing that anyone could say that I would give a shit about at all. I wouldn't, I really don't
You're
care.
untriggerable?
And
yes, you are.
Well, no, about stocks, about the market. Here's the best word I've come up with to describe where I am with other people's opinions. I'm dispassionate. Like, if someone's like, dude, I bumped into this guy at the beach club the other day. By the way, this is my nightmare. Having to talk market stuff with somebody I've never met before, and them being like mad at something I said. He's like, "Oh, I heard what you said about whatever it was." Like arguing with me. I'm like, "All right, maybe you're right. Get the fuck out of here. Leave me alone." Yeah. Like, you could be right. I'm not in love with my own opinions. And by the way, I might agree with you tomorrow. I might change my mind. What are you so worked up about? What's wrong with you? If I'm wrong and if I'm an idiot, then just take the other side. It's very simple. I'll lose money. You'll make money. So I know that on the internet, there's this whole cottage industry of people being furious about other people's opinions. It's getting harder and harder for me to understand it. What's the difference if somebody doesn't agree with you? I don't know.
I'm very happy. My outrage is in secular decline. I used to get worked up, but I think I'm with you.
Maybe somebody will say something about a stock I own that'll make me mad at some point. I just can't imagine.
Probably not.
All right, that's all I got. Wait, what about you?
All right, last thing. So, you started a podcast, which this video will be included in. You've done 3 so far, maybe? They come out on Friday morning. How's that been so far? Yeah. So it's just you riffing for like 15, 20 minutes, which is incredibly difficult. Might not sound hard, but try it. It's very difficult. How are you enjoying it?
I love it because it forces me to really think about what I think. And that's why I started the blog, or that's what I get the most out of doing the blog. It's the same thing with the podcast. It's like, I have this opinion, but I have to really research it to make sure that it's really my opinion. And then a lot of times in the process of researching what I want to talk about, there'll be some nuance introduced that will maybe cause me to change my mind about something. And I love surprising myself. Just looking at the data versus what my initial impression is. So that's the process for coming up with what I want to discuss at the top of the podcast. And I feel like as an investor, I'm getting a lot out of it.
Do you listen back to it?
No, I hate the sound of my voice.
So
I sound like the older guy in the Beastie Boys. I sound like Adam Yauch sometimes.
I listen,
and I hate it.
I listen to my podcast only because there's Ben. So I'm not just listening to myself. I also would find that very, very difficult. I also find it difficult because I hear myself literally 2 days ago and I disagree with myself 2 days later. But if it was just one, just solo, I wouldn't be able to listen.
Well, one of the things to balance is to have an opinion that's strong enough that it's worth people listening to, but not so strong that you can't change your mind. And it's hard to do that. It's hard to do that, but if you don't do that, I feel like you're letting down the people who are paying attention to what you're saying. Like you have to give yourself an out to say, okay, this is why I thought what I thought, but this is what's changed my mind. If you're just like, look, here's how it is. I'm an expert on how the world works. You could probably do that for a few weeks and people will love listening to it because they love certainty, but you're in the long run not helping anybody. What are your thoughts on the topics Michael and I discussed today? We love your feedback. Always helps us make for a better show. We always get a lot out of hearing what you guys think about these topics. So go ahead and leave us that feedback. Subscribe to the channel if you have not already. Congratulations to Michael and Ben. Their podcast, Animal Spirits, has hit 5 million lifetime downloads, which is a major achievement in podcasting, any vertical. So congrats to you guys. Make sure you're following the Animal Spirits podcast as well. We will be back very soon.